Silver hits $121 ATH. Copper, $6.50. Surge. Is this the supercycle? Silver just shattered every record in history. $121 per ounce. Copper exploded past $6.50. The sharpest single-day surge in 16 years. But here's what nobody's telling you. This isn't a rally. This isn't speculation. This is something far more dangerous. A structural fracture in the global monetary system. China is hoarding. The West is bleeding. And the paper markets, they're hiding a secret that could redefine wealth itself. By the end of this analysis, you'll understand why some of the world's largest institutions are quietly preparing for a repricing event that happens once in a generation. The question is, will you be positioned before it unfolds, or will you be among those who realize too late? Welcome to IU and Ag. Now, before we proceed into what could be one of the most important economic analyses of this decade, a humble request. If you've been following markets for years, if you've witnessed cycles come and go, if experience has taught you that preparation matters more than reaction, then you already understand the value of staying informed. So take a moment. Subscribe to this channel, press that notification bell, not for us, but for yourself. Because in the months ahead, this information may prove invaluable. Now, tell us in the comments, where are you watching from today? Which part of the world is paying attention to what's unfolding in these metal markets? Let us know, and let us begin. On January 29th, 2026, something extraordinary happened in the global metals market. Silver crossed $121 per ounce. Not $30, not $50, not even $80. $121 for a single ounce of silver. On the same day, copper shattered records above $6.50 per pound, the sharpest single-day surge in 16 years. Traders in London watched in disbelief. Analysts in New York scrambled to revise their models. And in Shanghai, the phones didn't stop ringing. To understand why this matters, one must first understand what a supercycle actually means. A supercycle is not a normal price rally. It is not a temporary spike driven by speculation. A supercycle is a fundamental repricing that unfolds over years, sometimes decades. It happens when the world changes, when old systems break down, and new realities demand new valuations. The last time markets witnessed a true commodity supercycle was in the early 2000s. China was industrializing at breathtaking speed. Demand for raw materials exploded. Copper tripled. Silver surged. Oil reached levels nobody thought possible. Fortunes were made, and fortunes were lost. But what is happening now may dwarf everything that came before. Consider the numbers carefully. Silver has rallied 450% over the past 2 years. Not 45%, not even 145%, 450%. This single metal has added over $6 trillion to its market capitalization. It has become the best performing asset class in the world. Not cryptocurrency, not technology stocks, not real estate. Physical silver, a metal that humans have valued for over 5,000 years, is now outperforming every modern financial innovation. Copper tells a similar story. On that historic January day, copper futures jumped 7% in a single session. In London, trading, prices exploded past $14,000 per metric ton. Veteran traders, men and women who had spent decades watching these markets, called it unprecedented. They had seen rallies before. They had seen crashes before. But they had never seen anything quite like this. The immediate trigger appeared simple enough. China announced new stimulus measures. The dollar weakened. Investors rushed into commodities. But seasoned observers knew better. They understood that triggers only matter. When underlying conditions are ready to explode, a spark means nothing in an empty room. But introduce that same spark to a room filled with gas, and the result is very different. The global metals market in early 2026 was filled with gas. Years of underinvestment in mining, declining ore grades across major deposits, political instability in producing regions, environmental regulations limiting new exploration, and demand that was growing faster than anyone had predicted. Solar panels required silver. Electric vehicles required copper. AI data centers required both. Defense systems required both. The green energy transition, the technological revolution, the geopolitical reshuffling of global power, all of these forces converged on the same bottleneck: physical metal. And here is where the story becomes truly interesting. For decades, the price of silver and copper was determined by paper markets, futures contracts, options, derivatives, financial instruments that represented metal, but were not themselves metal. This system worked well enough as long as physical supply remained adequate, as long as everyone trusted that the metal would be there when they needed it. But what happens when that trust begins to crack? What happens when buyers start demanding actual delivery? What happens when the paper promises exceed the physical reality by a factor of 350 to 1? That is precisely what began happening in late 2025. And by January 2026, the cracks had become fractures. The fractures had become breaks. And the breaks were threatening to become a complete structural collapse. The traders celebrating record prices did not fully understand what they were celebrating. They saw profits, they saw momentum, they saw opportunity. But beneath the surface, something far more significant was unfolding. A repricing event that would separate those who understood from those who did not. The supercycle had begun, and most of the world had no idea what was coming next. Deep beneath the Atacama Desert in Chile, something was dying, not a person, not an animal, but something far more consequential for the global economy. The richest copper deposits on Earth were slowly bleeding out. For over a century, Chile had been the beating heart of global copper supply. Miners descended into the earth and emerged with ore so rich it practically refined itself. 25% of the world's copper came from this narrow strip of land. But in 2026, the numbers told a troubling story. Ore grades had fallen by nearly 30% over 2 decades. Miners now had to dig deeper, process more rock, consume more water, burn more energy, all to extract less copper than before. Glencore, one of the largest mining companies on the planet, made an announcement that sent shockwaves through commodity markets. They were cutting their 2026 copper production forecast. Not because of weak demand, not because of falling prices, because the mines themselves were failing. Aging infrastructure, water scarcity, political uncertainty. The ground that had given so generously for generations was now demanding a price too high to pay. But copper was only half the story. Silver faced an even more alarming reality. Over the past 5 years, the world had consumed 678 million ounces more silver than it produced. Let that number settle in the mind. 678 million ounces. That represents nearly 1 full year of global mine production. Simply missing, gone, absorbed into solar panels, embedded in electronics, locked away in vaults, never to return to circulation. And unlike copper, silver has no major dedicated mines. 70% of silver production comes as a byproduct. Miners dig for gold and find silver. They dig for copper and find silver. They dig for lead and zinc and find silver. This means something critical. Silver supply cannot respond to price signals the way other metals can. When silver prices rise, mining companies cannot simply open new silver mines. Because pure silver mines barely exist. The metal is hostage to the economics of other commodities. Now add another layer of complexity, China. The dragon that had transformed global manufacturing. It was changing the rules of the game. For years, China processed and refined the majority of the world's silver. Raw ore flowed in from mines across the globe. Refined silver flowed out to factories everywhere. But in late 2025, Beijing made a decision that altered everything. Export licenses became harder to obtain. Restrictions multiplied. Refined silver, once freely traded, became a strategic weapon. The evidence appeared in the price spreads. In Shanghai, silver traded at $138 per ounce. In London and New York, the price hovered around $121, a $17 premium. $17 more for the same metal, simply because of geography. This gap was not normal. In healthy markets, price differences disappear quickly. Traders buy low in one market, sell high in another, and the gap closes. But this gap refused to close, because the silver could not move. China was holding its refined metal inside its borders, and the rest of the world was beginning to feel the squeeze. Consider now the refining bottleneck. Even when silver ore existed, it could not become usable silver without refineries. And in late 2025, approximately 9.7% of global refining capacity went offline. Equipment failures, maintenance backlogs, energy shortages. The metal existed somewhere in the earth, but the pathway from rock to refined product had narrowed to a choke point. Veteran commodity analysts began using language rarely heard. Supply destruction. Not supply shortage, not supply tightness. Destruction. The word carried weight. Shortage implies temporary scarcity. Destruction implies permanent damage. Mines that close rarely reopen. Ore grades that decline never recover. Skilled workers who leave the industry seldom return. Refineries that shut down take years to rebuild. The business community watching these developments faced an uncomfortable truth. Modern economies run on assumptions of abundance. Factories assume materials will arrive. Manufacturers assume supply chains will function. Investors assume markets will provide. But what happens when those assumptions break? What happens when the Earth itself can no longer deliver what civilization demands? The supercycle thesis rested on this foundation. Not speculation, not excitement. Cold geological reality. The easy metal had been found. The rich deposits had been exploited. What remained was deeper, leaner, harder to reach, and the world's appetite was growing faster than ever before. In a windowless room in Nevada, rows of servers hummed with quiet intensity. No humans walked these corridors, only machines, thinking, learning, consuming. This was an AI data center, one of thousands being built across the world, and hidden within its endless racks of processors was a hunger that few understood, a hunger for metal. Each server required copper wiring. Each cooling system demanded silver contacts. Each power connection relied on conductivity that only precious metals could provide. A single large-scale data center could consume more copper than a small town uses in a decade. And the world was not building one data center. It was building thousands. The artificial intelligence revolution had arrived. But it came with a price tag nobody had fully calculated. Not in dollars, in metal. Every query to an AI system, every image generated, every algorithm trained required physical infrastructure, and that infrastructure required copper and silver in quantities that staggered the imagination. But AI was merely one thread in a much larger tapestry. Consider solar energy. The great green hope of the 21st century, every solar panel ever manufactured, contains silver, not as decoration, not as luxury, as necessity. Silver paste forms the electrical pathways within each panel. Without silver, solar panels cannot convert sunlight into electricity. There is no substitute. Engineers have searched for decades. They have tested aluminum. They have tested copper. They have tested synthetic compounds. Nothing matches silver's conductivity. Nothing matches its reliability. Nothing matches its performance under extreme conditions. In 2020, the solar industry had consumed approximately 100 million ounces of silver annually. By 2025, that number had doubled to 200 million ounces. By 2030, industry projections pointed to 450 million ounces every year, just for solar panels. Now consider electric vehicles, the automotive revolution that governments worldwide were mandating. A traditional gasoline car contains approximately 20 kilograms of copper. An electric vehicle contains 80 kilograms, 4 times more. Every electric motor requires copper windings. Every battery system requires copper connectors. Every charging station requires copper cables. The world had committed to replacing 1 billion combustion vehicles with electric alternatives. The copper required for this transition alone exceeded current annual global production many times over. And silver played its role here too. Electric vehicle electronics demanded silver contacts. Battery management systems required silver soldering. High-performance connections relied on silver's unmatched conductivity. A single electric vehicle could contain up to 1 kilogram of silver. Multiply that by millions of vehicles annually, and the numbers became staggering. Defense contractors understood this reality better than anyone. Modern weapons systems ran on precious metals. Guided missiles required silver-based electronics. Communication systems depended on silver contacts. Radar installations consumed copper in vast quantities. Fighter jets, submarines, satellites, all demanded metals that were becoming scarcer by the day. The Pentagon had noticed. In August 2025, the United States government added silver to its critical minerals list. This was not symbolic, this was strategic. Silver had officially become a matter of national security. But perhaps the most dramatic demand driver came from financial markets themselves. Exchange-traded funds, ETFs, had transformed how investors accessed precious metals. Instead of buying physical bars and coins, investors could purchase shares in funds that held metal on their behalf. Simple, convenient, liquid, and devastating for physical supply. In early 2025 alone, silver ETFs absorbed 95 million ounces. 95 million ounces, removed from circulation, locked in vaults, unavailable for industrial use, unavailable for delivery, simply stored. While factories scrambled for supply, while manufacturers paid record premiums, financial investors accumulated metal they would never touch. The mathematics became impossible to ignore. Solar demanded 450 million ounces by 2030. EVs demanded their share. AI infrastructure demanded its share. Defense demanded its share. ETFs absorbed everything they could find. Total global silver mine production stood at approximately 800 million ounces annually. Demand was rapidly approaching and threatening to exceed every ounce the Earth could provide. This was the demand acceleration matrix. Multiple forces from different industries, in different countries, with different motivations, all converging on the same finite resource, not in sequence, simultaneously. The business leaders who grasped this reality began repositioning quietly. They secured long-term supply contracts. They stockpiled inventory. They hedged their exposure. Those who dismissed the signals continued operating as if tomorrow would resemble yesterday. But tomorrow was already arriving, and it demanded payment in metal that was no longer available at yesterday's prices. In a quiet office in London, A veteran trader stared at his screen in disbelief. The numbers made no sense. For 30 years, he had traded silver futures. He understood the rhythms, the patterns, the logic. But what he witnessed in January 2026 defied everything he thought he knew. The paper market said silver was worth $121. The physical market said something else entirely. In Shanghai, buyers paid $138. In Mumbai, premiums reached historic levels. In Dubai, dealers quoted prices that would have seemed absurd a year earlier. The gap between paper and physical had become a chasm. To understand this divergence, one must first understand how precious metals markets actually function. For decades, the price of silver was not determined by physical transactions. It was determined by paper contracts, futures, options, derivatives, financial instruments that represented silver, but were not silver themselves. A trader in New York could buy 1 million ounces of silver. Without a single physical ounce changing hands, he would simply own a contract, a promise, a piece of paper. The system created extraordinary leverage. For every 1 ounce of physical silver held in exchange vaults, there existed 350 ounces in paper claims, 350 to 1. As long as most traders never demanded physical delivery, the system functioned smoothly. Paper traded against paper. Prices moved up and down, profits were made and lost, and the actual metal sat quietly in vaults, rarely disturbed. But something changed in late 2025. Industrial users began demanding delivery. Solar manufacturers needed actual silver. Electronics companies needed actual silver. Defense contractors needed actual silver. They did not want paper promises. They wanted metal. The first sign of stress appeared in lease rates. Lease rates represent the cost of borrowing physical silver. In normal markets, these rates hovered near zero. Silver was abundant. Borrowing was easy. But in late 2025, lease rates spiked to 39% annualized, 39%. To borrow silver for just 1 year, borrowers had to pay nearly 40% of its value. This was not normal. This was desperation. Then came backwardation. In healthy futures markets, prices for future delivery exceed current prices. This makes logical sense. Holding metal costs money, storage, insurance, opportunity cost. Future prices should reflect these expenses. But silver entered backwardation. Spot prices exceeded futures prices. Buyers were willing to pay more for immediate delivery than for delivery months later. This meant one thing. Physical silver had become so scarce that buyers could not wait. They needed metal now, at any price. The last time silver showed such severe backwardation was 1980, the year the Hunt brothers attempted to corner the market, the year silver touched $50 before crashing spectacularly. But 1980 was different. The Hunts were speculators. They wanted to manipulate prices. In 2026, the buyers were industrialists. They wanted to manufacture products. Their demand was not speculative. It was existential. Meanwhile, across the Pacific, China was playing a different game entirely. The People's Bank of China had accumulated 74.1 million ounces of gold, a record. At the same time, China's holdings of U.S. Treasury bonds fell to an 18-year low, $686 billion. The message was unmistakable. China was exchanging paper American promises for physical precious metal. This was not coincidence. This was strategy. For decades, the U.S. dollar had dominated global trade. Oil was priced in dollars. Commodities were priced in dollars. Countries held dollar reserves. But that dominance rested on trust. Trust that the dollar would hold its value. Trust that American debt would be repaid. Trust that the system would remain stable. China had decided to hedge against that trust. Gold could not be printed. Gold could not be sanctioned. Gold could not be frozen in foreign bank accounts. Physical metal in Chinese vaults belonged to China alone. No American president could seize it. No Western bank could restrict it. No financial sanction could touch it. And silver. Silver gave China something even more powerful: leverage over Western industry. By controlling refined silver exports, Beijing controlled the supply chains of its competitors. American solar panels needed Chinese silver. European electronics needed Chinese silver. Western defense systems needed Chinese silver. This was economic warfare, conducted without a single shot fired. The implications for business leaders were profound. Those who held physical metal possessed real assets outside the paper system. Those who relied on futures contracts held promises that might never be fulfilled. Those who understood the divergence could position themselves for the repricing ahead. Those who dismissed it would learn expensive lessons. The supercycle was not merely about prices rising. It was about a fundamental shift in how value itself was measured. For 50 years, paper instruments had determined the worth of physical resources. That era was ending. Physical scarcity was reasserting itself. And those who recognized this shift would navigate the decade ahead very differently. from those who clung to outdated assumptions. The question was no longer whether the repricing would occur. The question was how violent it would become, and whether the world's institutions could manage the transition without fracturing completely. End of Part 4. The complete script is now finished, all 4 parts delivered as requested.